Good afternoon and welcome to today's discussion by the Institute of International Monetary Research in collaboration with the Vincent Centre for Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I'm Ewen Stewart, I'm the Director of the IIMR, and today we'll be hosting John Greenwood, who I think will be known to very many of you. But for those of you that don't know John, he was Chief Economist and founder of International Monetary Monitor Limited, a macroeconomic consulting firm. He's a graduate of my home city, Edinburgh University. John did a postgraduate research at the University of Tokyo, and he was visiting research fellow at the Bank of Japan. From 1974 to 2021, he was a business economist covering financial markets, first with GT Management in Hong Kong and San Francisco, and later with Invesco in London. As editor of the Asian Monetary Monitor, he proposed a currency board scheme for stabilizing the Hong Kong dollar in 1983. That scheme is still in operation today. He's a member of the Committee of Currency Board Operations for the Hong Kong Monetary Authority since 1998. He's also a member of the Shadow Monetary Policy Committee in England, and he's the academic advisor to our institute, the IIMR. John is just back from spending quite an extended period of time in South Africa. Today, we're going to talk about actually monetary policy and inflation in South Africa during the COVID period. John, welcome, and thank you so much for giving your time today. I think this is an area that's been neglected and very under-researched, so it's a great pleasure that you can sort of fill us in what's happened. John, just give us some background on this, if you may.
Well, I was really intrigued to discover during my visit to South Africa that unlike many countries like the US, the UK, the Eurozone, and so on, South Africa's inflation had not risen really materially at all during and after the COVID episode. So as a monetary economist, I was very interested to discover what the roots of this sort of success were. How had South Africa managed to avoid the inflation that so many other countries seem to experience? So partly while I was there, but more subsequently when I returned, I looked into this and I wrote a paper about it, which is available on my website. The essence of the story is essentially this, that during COVID, the South African Reserve Bank did not engage in large-scale quantitative easing or money creation. And the overall rate of growth of what we call broad money, that is M3, remained pretty subdued. And therefore, there was no excess liquidity in the economy to generate a high rate of inflation. Let me give you some numbers. Before the global financial crisis, that's so not COVID, before the GFC of 2008-9, average money growth in South Africa, and this is using the M3 measure, had been about 15.5% per annum. And that generated an inflation over the period 1970 to 2008 of 10.3% on average. But then after the GFC, the money growth rate roughly halved from 15.5% to 6.9%, so to about 7%. And the inflation rate also halved from roughly 10.3 to 5.1. So that was a significant step in the right direction. And the really interesting thing is that South Africa didn't put its foot on the monetary accelerator during and after the COVID crisis. They took fiscal measures, which we may talk about later, but from a monetary point of view, they lowered interest rates, and the central bank increased liquidity temporarily. That's to say, it provided liquidity to the banking system through a couple of different operations, buying some government securities and lending to the banks. But within a few months, certainly by the end of the year, by the end of 2020, all of that excess liquidity had been removed from the markets. And as a result, money growth remained on its sort of previous course, a course that I described since the GFC, that is a low average growth rate of about 7%. And the net result is that although there was a temporary sort of spike up of inflation, it was really very modest. It was less than 10%, and it very soon came back down again. So in broad terms, the lesson that South Africa teaches is that if you maintain steady growth of broad money, that is money in the hands of the public, M3 in this case, you do not have to have inflation. And in fact, the inflation rate of in South Africa has recently been very low, below 4%, which for South Africa is a significant achievement. So all in all, although we don't have many examples, South Africa joins the case of countries like China, Switzerland, and India, which did not experience COVID inflation, and therefore helped to bolster the general case that it was monetary excesses that caused the COVID inflation, not supply chain disruptions.
John, that's absolutely fascinating. I think the correlation with the money growth in South Africa, India, China, and Switzerland is extremely compelling evidence. Can we just jog back a little bit? Do you want to tell us about the nature of the South African central bank? If our central bank is pretty Keynesian in its philosophy, how would you describe theirs, and how independent do you think it is?
Well, let's start with the issue of independence. There's a section of the Constitution of South Africa, Section 223, which was promulgated in 1996, that states that the South African Reserve Bank, the SARB as it's known, is the central bank of South Africa, and Section 224 says that its mandate is to protect the value of the currency in the interest of balanced and sustainable economic growth in the Republic, and that in pursuit of its primary objective, it must perform its functions independently. So that's in the Constitution. And what that means in practice is that it has what we call instrument independence, because that particular clause goes on to say there must be regular consultation between the bank and the cabinet member responsible for national financial matters. That's the Minister of Finance. Yeah. And in practice, what happens, as in this country, just as in this country, the Treasury sets the inflation target, the Bank of England is left to get on with it. The same happens in South Africa. The Minister of Finance sets the inflation target, and the Reserve Bank is left to get on with it using, primarily its interest rate tool, but also, loans to the banks or purchases of government securities and so on. So it has instrument independence, but there is good coordination between the Treasury, the Minister of Finance, and the central bank. So it doesn't kind of veer off on its own and do its own thing. My understanding is that these meetings between the governor of the bank and the Minister of Finance are fairly regular. And in addition, like members of the Bank of England, members of the South African Reserve Bank are required to testify before select committees of Parliament in South Africa, in Pretoria. So that is sort of the constitutional position. Whether we can say it's broadly Keynesian or monetarist, I think is more difficult. And maybe it's not really very appropriate. The board of directors is very diverse. There are up to 7 members of the Monetary Policy Committee. Currently, there are 5, and they are all required to be members of the South African Reserve Bank. So they don't have externals on that committee. Now, the governor, in a statement a couple of years ago, said that up until 2000, the year 2000, the South African Reserve Bank had followed what he called an eclectic approach to monetary policy, choosing between various different modes of operating. And they switched to so-called inflation targeting in the year 2000. But I don't think they were, as I indicated from the record I gave of money growth, they were not very successful until after the GFC. And one of the reasons I think for that is that until last year, the target set by the Minister of Finance had been quite a broad one. It was 3 to 6%, with the South African Reserve Bank targeting the midpoint of that range, that is 4.5%.
Is it worth touching on the South African experience of COVID? In the UK and in Europe and to an extent America, there was a very harsh lockdown. In the UK, there was furlough and various other loan schemes. And I would argue the cost of that was funded by quantitative easing. We could debate exactly how precise that mechanism works, but certainly the QE program matched roughly the cost of lockdown, give or take. Do you want to run us through the South African approach, how they managed not to print a lot of money at that point?
The lockdown in South Africa was among the most restrictive in Africa and in the world. All non-essential businesses were closed. People were only allowed to leave their homes for food, medical care, and work that was deemed essential. And to enforce the lockdown, as well as distribute food, medicines, and other essentials, the government deployed the police, the National Army, and private security forces in different parts of the country. They banned the sale of cigarettes and alcohol, closed schools, banned public transport, closed the borders, and enforced strict stay-at-home orders for millions of people who relied on daily earnings to pay for basic necessities such as food and lodging. So it was certainly very harsh. The reactions, I think, were quite mixed. Some have criticized the measures, pointing to hunger, violence in some of the townships, increased militarization of the police. But others have praised an orderly and necessary lockdown and the general respect that the population as a whole paid to the government orders. Now, to get on to the sort of fiscal side of things, while some extolled the government aid to the population through, well, there were supplements to the pre-existing social protection payments, there was introduction of a special COVID-19 social relief of distress grant and food parcels. And the overall spending was about 500 billion rand, which is close to 10% of GDP. So it was quite considerable, perhaps not as great as in this country. But measures also included tax relief, various sort of fast tracking of VAT refunds, deferrals of excise taxes on things like, well, a variety of goods, including alcohol and tobacco, although those were later banned altogether. And this meant that the debt to GDP ratio increased from 58% of GDP pre-COVID to about 70% of GDP in 21-22. And it's recently crept up to close to 80%. So you can see it was certainly harsh, but there was considerable fiscal spending. And as a result, I mean, and because the measures taken by the Reserve Bank were kind of only temporary, they temporarily boosted the size of the balance sheet and then shrunk it back again. They didn't end up with a kind of inflationary overhang in the form of excess money in the hands of the public.
I mean, that's interesting. I mean, just as a reference, the debt to GDP ratios at 80% is about 15 points less than the UK, as you know.
Yes.
And, about 30 points less than the United States of America, if not slightly more than that, 40 points less. So they managed the situation. It seems to me you're presenting a picture that while there was a fiscal response, it was reasonably orderly and without a commensurate QE. Was there a QE program at all?
Essentially, no. I mean, they certainly didn't call it QE. As I said, and I quote in my paper, they called it a liquidity injection. So in addition to cutting interest rates, they provided some liquidity. And they did that partly by lending directly to the banks and partly by increasing the amount of repos they did in the private sector. So purchasing short-term securities, some of them from the banks, some of them from the private sector. And they only bought a very small amount of long-term government securities.
Thank you for that, John. In terms of current inflation, we're now 3 or 4 years beyond the lockdown. What is the current inflationary trend and the money growth trends in South Africa?
Yes, well, I mentioned before that CPI had been in double digits up until about 2008. And then it roughly halved to about 5% subsequently. Now, since September 2024, inflation has come down below 4%, which is good for South Africa. And in the latest figure we have, is for January this year, January 2026, the figure was 3.5% year over year. Now, the background to that is this switch to inflation targeting, but I think a more focused approach to limiting liquidity. Importantly, there was a conference held at the South African Reserve Bank in March last year, 2025, which included international scholars, foreign central bankers, and researchers from the Bank of International Settlements. And it was generally agreed that the 3 to 6% target was too lax, and the SARB, the South African Reserve Bank, could do better. In November of last year, 2025, the government changed the target from the 3 to 6% range to 3% with a tolerance band of 1% on either side. So it has lowered the target, if you like, from 4.5%, well, that's the middle of that 3 to 6% range, to 3%. And now they only talk about the 3%, although they're aware there is this tolerance band. And as I say, the money growth rate has remained pretty low and stable, about just under 7%, which for South Africa, given its growth rate and the amount of financialization, that is the increase in demand for money holdings, as people get richer. That is probably compatible with an inflation outcome of close to 3%. So I would say they're on track to broadly hit the 3%. Of course, there will be random events like the current oil crisis, which may push prices up in the short term. But from a monetary point of view, South Africa seems to be doing the right thing.
This just in slight contrast, perhaps, to the image one gets of South Africa, the governance of South Africa. Is perhaps the popular image wrong? Then actually the political elite are a lot more disciplined, and South Africa has maybe learned the lessons of short-termism, or I'm just curious how they've managed to keep such a tight lid on it.
Well, one of the disciplining factors, I think, has been the weakness of the exchange rate.
Yeah.
And that could easily have translated into quite a high inflation rate. Now, the fundamentals behind that are probably the fact that there was this transfer of government to Black South Africa. And a lot of people were concerned that property rights would not be respected. There were fears of capital flight and so on. And there's no doubt that when you go to South Africa for somebody from the UK or Europe or the US, things are very cheap. It's a very attractive place for us to spend our money. But the converse is also true for South Africans. Because of this big depreciation of the exchange rate that they've suffered over the last 25 years, they feel that going abroad is very expensive, and their rands don't go very far. So in order to kind of offset that, they're going to have a pretty disciplined store or shop at home, both on the monetary and on the fiscal front. And I think that is an important component that they always have in their mind when they're thinking about what to do. So they're not going to go on a sort of fiscal rampage and spend a lot of money to create jobs for all those unemployed people, because they know that will damage the exchange rate. They're uncomfortable with that, and clearly it's a potential source of social unrest. There is a lot of immigration that is difficult to control from many other parts of Southern Africa. And those people have relatively low skills. But in a way, that kind of helps, because it means that South Africa has a very wide spread of incomes. And a lot of things can be done very cheaply. I'm not defending that. I'm just saying that is the case.
Yeah, I understand.
People still talk to me about South Africa still having, in effect, a dual economy. So there's a modern sort of sector which requires high skills and is highly efficient. But there's also this informal sector with very low pay and little security. And it's difficult to for workers, imagine, to make that transition. Now, education is widespread and very pervasive in South Africa. I don't think there's any sort of failure of the education system, but a lot of children leave school at a very early age, 12, 13, 14, and therefore they don't have the skills to participate in the advanced modern formal sector of this dual economy structure.
Commodity prices are generally high, particularly gold. And do you think that has been a fillip to the economy to an extent, or has the South African economy moved well beyond being a resource-driven economy, do you think?
It's helped, but South Africa is very diverse now. I mean, I did a quick sort of check of what the major generators of income in the Cape Town area were. And turns out the largest single contributor is finance, insurance, real estate, and business services. So that's a bit like the UK.
Mm-hmm.
Then you've got a very active wholesale and retail trade, tourism and hospitality, manufacturing, technology and innovation, agriculture and agribusiness, trade and logistics. There's not much mining in the Cape Town area, and I was only sort of in the Cape Town area, but the resource dependence in that sort of group of sectors is quite limited. So it is a very diverse economy. And my impression was that the Cape Town area was very prosperous. I was impressed with the high quality of the infrastructure. The roads and highways were very well maintained. There were no power cuts, what the South Africans called episodes of load shedding by the electricity monopoly while we were there, so we were exempt from that. So Cape Town's income and wealth spring from a pretty diverse, service-driven regional economy. And my understanding is that that accounts for about 10% of South Africa's GDP. And the Cape Town region accounts for 72% of the Western Cape's economic activity. So it's a very robust, powerful economic engine within South Africa. But I mean, the long-term challenges are clearly this high rate of unemployment, the problems of the black townships, and the continuing immigration. That all of that is in part a sort of residue of the apartheid era inequality. There's high youth unemployment. But people also complained about the high cost of doing business and the fact that economic growth over the past decade or so has been relatively weak. And they blamed the government for too many rules and regulations. So the government is not exempt from a tendency to intervene, but mercifully it hasn't been too interventionist.
Well, John, this has been a really fascinating conversation. I don't know if there's any other last thoughts you'd like to leave us with. I think it's a very positive story, a very important monetary lesson, actually. And I think more work needs to be done on this, and particularly what also happened in other saints, Switzerland, China, and India, to name but three others. But I think this is an undertold story, and it's been absolutely fantastic for you to share that with us.
I'm sure we will find more countries, which did not succumb to the money printing.
Yeah.
But I think the bigger challenge that we face is to convince people that it was monetary problems at the core of the COVID inflation and not supply chain disruptions or the war in Ukraine. I mean, all these countries faced the same supply chain disruptions, but some of them did not have inflation. And the question is why? And I think this work that I've done on South Africa starts to provide an answer.
I completely agree. John, this is a really fascinating talk. Thank you very much indeed for your time, and thank you for tuning in. Thank you.
Thank you.